Hey, welcome back. We all love just tapping our phone to pay for coffee, right? It's so easy. But have you ever stopped to think about the system behind that tap? What if I told you that the entire digital foundation our money sits on, well, it's starting to show some serious cracks. So today, we're going to dive deep into those hidden vulnerabilities and explore a new vision for a digital safety net that's actually, safe. All right, so let's start with something we all get. I mean, look at this quote. The physical wallet, it's basically dead, right? It's just this thing in our pocket that collects old receipts. We've all gone digital. We picked the speed of bits and bytes over actual physical atoms because honestly, who wants to carry cash anymore? It's clunky, it's slow, it just feels old. But here's the thing, that incredible convenience, it came with a price, a trade-off that almost nobody talks about. See, when we ditch cash, we didn't just ditch paper. We replaced a public utility that's money backed directly by the government, totally risk-free, with a private one. Now our money is just a promise from a commercial bank. And trust me, that little difference, it changes everything. Okay, so what is this ghost of cash? Let's really dig into what we lost when everything went digital. So check this out. This is the absolute core of the issue. That bill in your wallet, that's a direct IOU from the government. It is, for all intents and purposes, risk-free. But that number you see on your banking app, that's not the same thing at all. It's just your bank promising to pay you. It's a liability on their books. And if that bank goes under, well, that promise might not be worth so much. That's called counterparty risk. And that brings us to a really important point. The whole debate isn't about, making a digital version of a dollar bill. That's kind of missing the forest for the trees. The real challenge, the big one, is how do we digitize the safety net that cash gave us? How do we get that risk-free guarantee back in a world that's all digital? Okay, so while we're all having these nice theoretical debates, a real fire has started, and it's spreading fast. There's a new threat out there, powered by AI, and our current financial system is it's not ready for it, not even close. I mean, listen to this quote, "The rise of the brilliant sociopath." That's such a perfect and frankly chilling way to describe generative AI. Think about it. These things can sound like your boss, look like your CFO, mimic them perfectly, but there's nothing behind the eyes. No conscience, no sense of truth, no liability. It is the perfect tool for a scammer. And this isn't some sci-fi movie plot. This literally just happened. A finance worker gets on a video call with who he thinks is his CFO and a few other colleagues. It's a deep fake, the whole thing. They look real, they sound real, they tell him to make an urgent transfer. He sends over $25 million. And the payment system? It just did it. No questions asked. Why? Because from its perspective, the instructions were correct. The from and to were valid. That's it. The reason that can happen is because our entire global financial system is built on dumb pipes. That's the perfect term for it. These systems, whether it's Swift or FedNow, they have one job, move money from here to there. That's it. They don't ask why, they don't check the context, they just follow the instructions. And in a world with brilliant sociopath AI, that's not just a flaw, it's a catastrophic vulnerability. So you see, the answer isn't to just make the dumb pipes faster. That doesn't solve anything. We need to make the money itself smarter. The actual data being sent, the payload, needs to carry its own proof that the deal is real and legitimate. It needs to be self-aware in a way. And all of this leads to a completely new way of thinking about banking, a model we're calling Agentic banking. Forget going to the bank. The bank is about to start coming to you. Okay, think about it. Right now, when you buy something online, you get to the checkout, and what happens? You leave the store. You're kicked over to your banking app or PayPal or something else. You leave the context of the deal to go to a separate destination to pay. The new model flips that completely on its head. The bank's software, its agent, comes into the deal with you. It doesn't make you leave. And that, right there, is the heart of agentic banking. The bank is no longer just a passive vault holding your money. It becomes an active, smart agent that's right there with you in the transaction, verifying everything before a single dollar moves. So how would this actually work? Well, let's say you agree to a deal. Step 1. Your bank's software agent gets invited into what you can think of as a digital meeting room for that deal. The agent looks around, verifies the context, and says, "Okay, this looks legit." It then puts a soft lock on the funds in your account. And here's the magic part. That money does not move until your bank's agent gets cryptographic proof that the deal is done. The goods have been shipped, the service has been rendered, whatever. The transaction is the settlement. They happen at the exact same time. Now, this agentic model is amazing for stopping AI-powered fraud, but it still leaves that one big question hanging, right? What about that ghost of cash? How do we get that ultimate government safety net back into the digital world? Yeah, let's hit that question head on. What happens if your bank goes bust, right in the middle of one of these agent-verified transactions? Where's your money then? This is where it gets really, really cool. This hybrid model basically turns deposit insurance from a slow, bureaucratic process into a real-time software function. So your transaction is happening in that verified digital room. Your commercial bank's agent is supposed to settle the payment, but it fails. The bank is insolvent. The system instantly generates cryptographic proof of that failure. And that proof automatically calls in the central bank's agent, which steps in and guarantees the funds right then and there. It's seamless. So what you get is the best of both worlds. You keep all the innovation and the competition of the commercial banks we have today, but you have the central bank acting as this silent, automatic backstop. It's not a retail bank you interact with, it's just a piece of code that guarantees the system, preserving the two-tier structure that works so well. So when you put it all together, it looks like we're standing at a crossroads. There are basically three ways the future of our money could go from here. Okay, path one, we can just keep doing what we're doing. A little incrementalism, maybe make the dumb pipes a tiny bit faster. Path two, we could go all in on a retail CBDC, where every single one of us has a bank account directly with the government. Sure, it's safe, but that's a huge centralization of power and raises massive privacy questions. Or there's path three, agentic banking, using smart design to give us the safety we need and the innovation we want. And you know, what this all comes down to is that the solution here isn't about inventing some new cryptocurrency or digital token. That's not the point. The real work is in building entirely new forms of trust. Trust that's designed from the ground up for a digital world, one that can handle the kinds of threats we're facing now. And this final thought really just nails it. The future of money isn't a new coin. It's a conversation, a signed, verified, and guaranteed conversation. We need to stop thinking about money as a thing, an object, and start thinking of it as an intelligent relationship managed by trusted agents. And if we can do that, well, that might just be the digital safety net we've been looking for all along.